Hello, welcome to TS Research View. I'm Larry Brainerd, Chief Economist, and today I'm going to update you on our most recent monthly strategy. We've taken a more optimistic view this month, and I'll explain why in a moment. But as you may know, we do a relative ranking across emerging market asset classes. This month we've cut sovereign credit by one notch. It's still positive, but it's moderate positive, down from strong positive. And we've upped equities to neutral. The main reason is because we see the next 6 months a generally more favorable global environment. If we look at the US, we see still positive growth, not booming, but the third quarter GDP numbers that came out late last week show us that final sales are somewhere in the 2.3% range, and that's up substantially from 1.7 over the previous 3 quarters. We have numbers from the Eurozone, and they continue relatively positive. So a positive global outlook, we think, will translate into positive performance for emerging market equities in particular. Our primary concern is the Fed. We do expect the Fed to hike rates 25 basis points in December, but we're not expecting a bond market rout. So we have cut our call on sovereign credit to moderate positive, and we think EM bonds will continue to perform well relative to other bond classes. Now, when we look at the countries and the regions, I think it's interesting, and we were a bit surprised, but we've come back to highlight better performance from the BRIC countries. We have positive ratings and equities on Russia, which is continuing, China, and India. And we've upped Brazil from negative to neutral. So 3 out of the 4 positive countries are in Asia, and we think Asian countries in general will continue to do relatively well compared to other emerging markets. When we look at bonds and local rates, our top calls are 2. One is Turkey, where we think sovereign credit has been sold off. We think it's undervalued at current spreads, and we see Turkish sovereign dollar bonds as a buy at these levels. We have a strong positive rating. We also like Brazil. Brazil has been an outperformer in a generally lackluster bond market. If we turn to local rates, our number 1 call on local rates is Brazil, where we expect to see gradual interest rate cuts over the coming 6 months. This will be positive for local bonds. We also like India, Russia, and a new addition is South Africa. South Africa, as many of you are aware, has been very much up in the air because of the charges against the finance minister, but our reading of the most recent developments is that he will stay in place, and the president, President Zuma, who has, we think, probably been the source of a lot of this upset, looks to be on the back foot. So we've increased our call on South African local rates, and this will be one of our absolute positive calls, and we'll go out with a research report in the near future. Our main concern and negative rating is emerging market currencies, and that's simply because we think dollar strength is going to be negative for emerging market currencies. So on a relative call basis, we've moved currencies to moderate negative. Now, of course, I'm not going to predict what's going to happen on November the 8th with the US elections. If you look at our past monthlies, we concluded that a victory by Donald Trump is not to be feared. There will be a short-term impact, but more likely the longer-term impact will be a strong dollar. But again, that's probably more than 6 months out. So thank you very much. If you'd like to follow up with discussions, please click on the link or get in contact with your trusted sources representative. Thanks.